2,400 square feet of solar array unfurls in low Earth orbit. This is the hardware behind AST SpaceMobile. They are attempting to build the first space-based cellular broadband network. The premise is direct. Turn every existing, unmodified smartphone into a direct-to-device satellite terminal the moment it loses terrestrial coverage. No extra antennas, no new hardware. This chart shows the company's stark financial reality. In 2025, AST generated about $71 million in revenue. That same year, they recorded a net loss of roughly $342 million. Yet the public market values this pre-commercial operation at over $24 billion. That valuation means the stock trades at an extreme multiple of around 168 times forward enterprise value to sales. To maintain that premium, AST points to a massive capital buffer. They hold roughly $3.5 billion in liquidity, matched against a contracted commercial backlog of over $1.2 billion. They also have the financial and strategic backing of major telecom incumbents, including AT&T, Verizon, Vodafone, Google, and American Tower. Because the market has already priced in success, AST must execute flawlessly. The next 18 months of their deployment schedule is a binary high-wire act where any delay directly threatens that $24 billion premium. To understand how they plan to meet that schedule, we have to look at their manufacturing base in Midland, Texas. AST controls 95% of its production vertically, keeping almost all major manufacturing in-house. That facility produces hardware backed by a deep intellectual property portfolio, spanning over 3,800 patent claims that specifically govern direct-to-device operations. This schematic compares a standard messaging satellite to AST's BlueBird phased array. The 2,400 square foot footprint allows it to project a massively powerful signal down to Earth. Size dictates capability. While competitors offer low-bandwidth text messaging using L and S bands, AST targets true broadband, reporting peak speeds of nearly 100 megabits per second directly to an unmodified phone. They have also cleared a major regulatory hurdle in the United States, securing the FCC's supplemental coverage from space authorization to operate these frequencies commercially. Building massive satellites, getting regulatory permission, solves half the physics problem. AST does not own rockets. They rely entirely on third-party launch providers like Blue Origin and SpaceX. That dependency introduces severe risk. In late April, AST lost BlueBird 7 when Blue Origin's rocket failed to reach its intended orbit. That single event resulted in an expected write-off of up to $160 million. Analysts estimate AST holds a 2-year technical lead in broadband space cellular. But that intellectual property and hardware advantage is entirely bottlenecked by the flight schedules and mechanical realities of their launch partners. Despite launch bottlenecks, AST is rapidly expanding its commercial footprint. They recently secured a $175 million prepayment from Saudi Arabia's STC Group to reserve network capacity. A more immediate catalyst is unfolding in Japan. A Rakuten and AST alliance is competing directly against a SpaceX consortium for the country's $1 billion J-LEO direct-to-cell project. Beyond commercial telecom, AST is actively positioning its U.S. subsidiary as a dual-use defense contractor. They recently won a $30 million prime contract from the Space Development Agency for the Halo Europa program. It is the first time AST has been selected as a prime contractor for a U.S. government space program. They followed that up by securing a prime awardee position on the Missile Defense Agency's SHIELD program. These contracts slot AST into the broader Golden Dome Initiative, a U.S. missile defense strategy that industry estimates place at a $175 billion total addressable market. However, government revenue is vulnerable to bureaucratic friction. Funding holdups at the Office of Management and Budget could delay significant program spending into fiscal year 2027. This defense integration provides a critical hedge. Recurring federal contracts would anchor AST to the national defense architecture, diversifying its income beyond the competitive commercial cellular market. Sustaining that high-burn operation requires capital. AST maintains a $3.5 billion liquidity cushion, heavily supported by raising $1.15 billion in 10-year convertible notes. Those notes carry a 2% coupon with an effective conversion price of roughly $96.30 per share. This graph illustrates the sharp divide in market sentiment. While retail capital inflows show massive, bullish conviction, institutional short interest has surged to roughly 41%. This is a genuinely directional bet against the company. Only 22% of short interest is tied to arbitrage. Long-side institutional capital is polarized. BlackRock added roughly $200 million, while quantitative funds like Jane Street liquidated, cutting holdings by 98%. Inside the company, the activity is decisively one-sided. Both the president and CTO have executed millions of dollars in stock sales over the last few months, largely under prearranged trading plans. The most severe stakeholder exit came from strategic partner Rakuten, dumping $271 million of stock, dropping their ownership below the 10% threshold. While retail traders bid up the stock on future potential, major stakeholders and executives closest to the technology are taking chips off the table. The urgency to lock in capital and contracts is driven by AST's most direct and dangerous competitor, SpaceX's Starlink direct-to-cell service. SpaceX owns its rockets. They control their launch schedule, operate with a massive cost advantage, and can rapidly refresh their satellite constellation without waiting in line for a ride. The scale disparity is absolute. Starlink already has roughly 9,500 satellites in orbit. AST is fighting to deploy 45 by the end of the year. Furthermore, SpaceX recently executed a $19.6 billion spectrum deal with EchoStar, arming Starlink with globally cleared frequencies that reduce their reliance on terrestrial carrier partners. Broader geopolitical shifts, such as recent U.S.-Iran peace reports lowering crude prices, provide minor economic tailwinds for the sector. But macroeconomic relief does not solve AST's structural launch bottleneck. AST is fighting a capital attrition war against a vertically integrated titan that controls every step of the supply chain to space. For investors seeking direct-to-device exposure without binary launch risk, Globalstar offers a much cleaner proxy. Globalstar already generates proven recurring revenue powering Apple's emergency SOS features via their licensed spectrum. This matrix shows the trade-off. Globalstar sits in the low-risk quadrant, locked by a $10.9 billion Amazon acquisition. AST SpaceMobile occupies the high beta quadrant. Their broadband capability perfectly aligns with future standards, proving their strategic logic is sound. But the clock is officially running. They have 18 months to convert their massive $1.2 billion backlog into actual revenue, relying entirely on a punishing third-party launch schedule. Wall Street analysts currently rate the stock a consensus hold, with price targets clustered around an $80 median, significantly below recent retail-driven peaks. The true indicators of their success will not be found in retail sentiment. Investors must track Japan's upcoming J-LEO contract decision, federal funding flows from the OMB, and strict third-party rocket schedules. AST SpaceMobile is a high-volatility bet built to capture a slice of a trillion-dollar market. But whether their 2-year technical lead survives contact with better-funded, vertically integrated competitors hinges entirely on near-perfect operational execution.